strength indicator is an application that you can download that is completely separate from anything that we're using here on our chart. It's a completely separate app that you can download from your Google or Android store. Yeah, I think it's called the Currency Heatwave or something like that. When you look at it, Jay Wayne has it up there. Yep, he has it on his tablet. It looks something like that. Like it shows you a gauge. If you can see Jay Wayne in the chat and where the pictures are, it shows you a gauge of the actual strength of the currencies, the volatility of the currencies. So now essentially when you look at that screen he has up right there, you're going to look at it and say, which one of these is the strongest? Which one of these is the weakest, right? So if Jay Wayne, like right now, Jay Wayne, which one of those is the strongest, one is the weakest, and we'll just go look at it. And I'll prove it. You're muted right now, so I can't hear you.
All right, so we're going to go with GBP, JPY. GBP is weak, JPY is strong.
Okay, so GBP, JPY, right? And we're just going to go to this just to see what it looks like. Because the currency heat wave is telling us that JPY is strong. It should be dropping off pretty substantially. Let's go check it out on an hour time frame.
So GBP should be selling, correct?
Yep, and sure enough, GBP is dropping off right now, and we're dealing with a little bit of consolidation because of the Asian session that we're in. But you see overall, that application is going to give you a heads up of where the strength lies in the market. And even here, right, what happened before this drop-off happened? And I'll give you guys the same thing I just showed you on the other chart. We have a high leading to a higher high, correct? Now let's see what we got on the RSI. We have a high leading to a lower high. The weakness was here. It pushed higher on the chart, but lower on the RSI, showing us that the weakness was already coming into the market, and now we're waiting for that pullback for the drop-off. So essentially, you saw all of this move potentially on the horizon way back here when this strength was falling off from this pair with the Great British Pound JPY. In this movement from top to bottom is about almost 200 pips. Yeah, about 203 pips, right? Within the last day. Okay. Yeah, currency heat wave is the application you can download. It'll definitely help you along your way. Yeah, and Jay Wayne's gonna make a video on it, instructing you guys on how to really use it and walk you through a little bit of ups and downs with it and how to kind of just basically just the do's and don'ts when you first get involved with it. Because in the beginning, like some of the stuff you see is like a lot at first, but in the beginning, you kind of got to work your way through. But it definitely helps out. And we're gonna be IML is gonna be doing a little bit more instructing on that as well, on how to use that tool as well. That's gonna become like one of the staple tools we have in IML in a little bit. We're just gonna get we're like the first ones to check it out. So you get to be like the first people to see how that works out. So with that being said, and that was just like a random pair we just pulled up, right? Because of what that had on there, this will give you a lot more strength, in your understanding of what to look for. So now we understand if the market's moving in a certain fashion, but I know for you guys, one of the things that's difficult in the beginning is where do I start? Like, where do I start looking at the chart? Like, what time frame should I look at when I'm about to start trading? Right? Some people get caught up in the, should I look at the hourly? Should I look at the 4 hour? Should I look at the 15 minutes? Should I be looking at the daily? If you go to the web analyzer, we have a great heat map for the different currencies. Oh yeah. The web analyzer has a lot of tools inside of there as well that you can add on with that as well. Great call out on that too, James. It just helps out a lot to have those tools in front of you, because sometimes it's difficult when you're just starting out and you don't know what to do and where to start. But for me, let me just give you guys a heads. Let me remove this because we understand that already with looking at the RSI, looking at high to high, high to high. And it works the same way if we're looking at lows, we're looking at the market to bounce to the upside too, right? If we're looking at, let's see if we can find something before it took off to the upside. Okay. All right, let me just zoom in on here and see if we can get some heads up here. What do we got? So, yeah, essentially the market was making lows. It kind of went sideways and dropped off here. On the 60 minutes, this thing just ran, and it gave us no divergence. It literally just made levels from low, high, and it just kept running from that standpoint. And all we can do is just draw our levels out from here and keep following the movement to the upside after that. So what I want to do is double back and go to the daily really quick and show you what I do when I start trading. The struggle of finding a head and shoulders, for example. Yeah, like when you're looking for a pattern, it's very difficult to find a pattern because a lot of times it involves so much patience. And then by the time you do get in, it's too late, right? The whole thing's done, it's formed, you're late. It's like, oh wow, the whole time you're sitting there telling everybody, I knew it was gonna happen. So it's like, yeah, well, did you make any money? But no, but I knew. So it's a struggle sometimes dealing with it. But one of the things that you can do is basically just start off on a high time frame like the daily. And when you do this, you want to look for areas of consolidation first. You want to look for areas of consolidation, and you want to look for areas where price stopped and started and stopped and started. And that way you'll have an idea of what to look out for. So something like this area here, like top to bottom, right inside of this zone here, is a good area. Like you see price made a low, and right when it got up inside of this zone, it kind of stutter step. But I want you to look at this too. This is very powerful. This is one of the zones I love teaching about. Please give the definition of divergence again. Oh, absolutely. Absolutely. Okay. See if we got one on the daily here. This is a small one, not really a big one. I want to find something that's like blatant, like you can see it really easily. So that way you guys can kind of keep up with it. I can get this thing to move right. Jeez. Okay. So I want it to be right in our faces, so it's like obvious, right? So this one is a little obvious, but it's a little more rudimentary, I guess, in a sense. So right here we have the market making absolute higher highs, right? High, higher low, higher high, higher low, higher high, right? Higher low. We think this market's gonna bounce from here and go to the upside, and it just drops off, retests, right? Everything looks pretty much natural inside of this movement. But what you see here is consistency, right? You're getting higher highs over and over, okay? The market is making complete higher highs. But when we look at the RSI, we got a high, a drop off, a high, but it's a lower high from our previous, right? Another drop off. Now follow where this line, how the crosshair is moving, follow where the crosshair is moving as I'm moving along with the price, okay? Let me just put this here so you can see what I mean. Okay, we got a high, and then we drop off and make a low. Another high, higher high on the chart, lower high on the RSI. Then we make another dip off, a low, right? Higher high on the chart, almost equal to lower high right here. There is absolutely no strength from the buyers, right? Every time the buyers show up and push price up, the strength of the buyers is getting weaker and weaker, and the sellers are going to get stronger and stronger. And now when we get that first break, right? Now we get that first break of structure because now we're making all these highs. We got to keep track of our highs, right? So now let's pull up our simple tools, like nothing too crazy, just pulling out our areas and showing out all the highs that we've had previously, right? Everything needs to make sense. So now what happens? Price breaks below an area that was once support. It breaks area that was resistance. This should be support now. It breaks right back down. We can't take this because essentially we didn't know this was coming. What you want to do is you want to put a sell limit at this level because you want price to come back and retest and take you with it. The whole thing, as when you become a very good trader, is you want the market to come back for you. You don't want to chase the market. You want to be very patient and let the market come to you. You prefer the line chart over the candlestick chart personally. Now, the thing with the line chart for me is it doesn't give enough information for the time frames, right? So we understand that on, like right now we're on a daily chart. Every candle here represents a day, okay? If I asked you what was the high and the low of the day, you would just say, okay, the high and the low is where the wicks are. So this wick was at this level here, somewhere around, 144.532, right? That was the low. Right here, a little bit higher. This was 147.492. That was the high. That was the low, right? Awesome. If we go to a line chart, I don't know the high and the low of this day. All I know is that price moved to a point and came back down, moved to a point, came back down. Even here, we didn't even see the wicks touch this area on the line chart. So this line chart is really one of those things where it's kind of like it doesn't give you enough information. Now, the line chart for me, like I said, it's just not enough information. Some people really, they prefer it over anything else. A lot of people prefer the bar chart where they see this one where it's kind of like these areas off to the side show the lows and the highs, and these areas where you see the little like arms coming off of it show the open and close of each one. Me, I'm old school. I like candlesticks. Oh, you go back. I like the candlesticks. I like to look at the chart and see exactly what I need to see in the grand scheme of things. That thing just took us way out of sync. Go back if we can. I'm gonna shrink this down a little bit just so we can see where we were. Here we go. Okay. I'm gonna zoom back in. There we go.
Oh my, so, coming in here. They was in here playing.
Remember we talked about our higher highs. We're not getting higher highs, divergence.
You can come in here.
So now that we see the market dropping lower, everything we had here from just one high for a breakout, one high leading to a breakout, these areas are very important on the downtrend. Now the market's breaking. We can't take the sell, wait for the retest. That line chart never gave us an entry from here. The candles did because price moved up to this area, touched that wick, activated us, and pulled us back into profit, right? This would be our first area for our potential exit. What did price do?
Is it bright?
Below this area.
Put it in here, see if it's brighter than the one that I got.
Broke below this area, and then what happens? Now we say if it breaks below this area, where was the first area to the left where price had an issue? We had an issue here where price right here stopped when it came down. So now if we break this area, this would be the first zone we want to see the candles come to before we see anything reverse. So we'll put an area here. We can include it. What did price do? False breakout, came right back up. And now it broke higher, got to this area, broke higher, retested. All these areas in the past are leaving clues for the future. Retested, moved right back up, never came up to this area, and now we're just ranging inside of this area right now. Okay, so all of these things you see here are going to start to pay a lot of dividends in the future. But I wanted you guys just to notice that how easy it is to mark up a chart with just simply having your levels of highs, lows, and consistently letting the market just breathe and come back for retest after you see these levels broken. Okay, and like I said, the divergence gave you what you were looking for. When you see those higher highs, always double back, right? Always double back. And then the whole thing is to confirm the divergence, make sure you get that first break of structure, okay? Just because it's starting to move down, divergence can happen, and then you can see a big move back again. You need to get that confirmation that that break of structure is happening. Now the divergence has much more strength and has more legs, and you can let that market run away, retest, drop off, and everything is going to start to pan out much more efficiently for you. Retest is when both candlesticks are side by side. No. What happens is for a retest, in the definition of this, hold on, I'm gonna go back to what Nathan said. When the market is open, a Zoom meeting should be used to times. Meeting should be used.
He was recommending us do something new.
Oh, okay.
Yeah.
I want to make sure I was following him.
Yeah.
Okay.
But the question is, the retest is a side by side. So we got to clear up what retest is.
Yes. So when you see something that is moving in a consistent manner, and all you want to do is make sure that levels are being broken. And when the level is broken, that's your first indicator. That's like your, oh no, it's all good. It's all good, Nathan. I'll double back and answer it for you a little bit later on, brother, with the candlesticks. It's recorded anyway, so we can always go back and watch it. But what happens, Tabitha, is when the market is broken, right? When you see a structure, not market, when the structure is broken in the market, where we're making consistent higher highs, and this level here was an area where we see the market was having problems breaking through, it pulled back and it finally made a push and broke it. This area now has relevance to us. We want to see if this is going to be an area where now it becomes support, it'll bounce from here and then break above this area and keep going higher still, and then keep retesting, going higher, basically making its own little stair step, going higher and higher. But what happens is once this level was broken to the downside, we weren't sure if it was going to be broken, so we didn't take this initial sale. We want to see the market come back up and retest this area. And that's why we always say no retest, no entry, because we want to make sure we're getting in where the market wants to solidify that this is now resistance. Okay? Just because this broke doesn't mean it's going to continue falling. We want to see some price action come back up and push away from this previous area. And essentially what happens is, like Nathan was saying, this right here almost looks like a head and shoulders. You have a shoulder, head, shoulder, drop off kind of thing happening. So you have to just be patient to let it happen. But most of the time, these areas like this are going to become like a bread and butter thing for you after you get used to looking left. Everything you need has already happened. And you're just going to basically build your case. It's like being a lawyer. You're building your case off of all the facts that you have, right? We don't have anything like if we're trading right now and we didn't know what was coming, if this was the very beginning of the chart, all the facts that we have to run with are back here. Okay? I can't tell you what's coming. I have no idea, but I do know what has happened. And in court, it's not what you know, it's what you can prove. So when we're trading, I can prove that price stopped here, dropped off and broke out because look what would happen. So now when price breaks out, I want to see if this is going to be proven again, and I can't do that unless it retests and moves away. Once I get that candle pushing up and pushing away, you can take an entry here for a potential sale and let the market drop off in your favor after that. Okay, now this is a daily time frame, by the way. So essentially, you have to make sure that your timing is much more efficient on the lower time frames when you have something like this drawn up on a daily. Okay. Oh yeah, no problem. No problem, Evelyn. I like to say that the past predicts the present for this sort of thing. Absolutely. Absolutely. Past always leaves clues. And another thing is this. Let me go to a lower time frame like the hourly and just show you what I mean. I'm going to go right to the beginning of this chart and just see what we got. Okay. Now, this is, you know what? I'm just going to go like completely left on this whole thing and just see what we got. Okay. I want to show you guys something that happens all the time in the market. And a lot of people don't take time to notice it because they're so busy trying to trade, you know, with the trend and how the market's moving. And they don't want to pay attention to anything outside of that. Now, right here, this is random. I'm just stopping right here to show you guys something. This area was moving extremely fast, right? Just drop off, complete falling, right? This is not normal in the market because what is this area missing right now? Right? There's something that has to happen for a healthy market to be considered healthy. If you guys don't know what it is,
it's missing a retracements.
Absolutely. You have to have retracements within a healthy market. This kind of movement is not sustainable. It's not duplicatable. It's not something you should look for every day. This will not happen frequently. Okay. So knowing this puts us in a mind frame of, okay, if the market was moving this fast and it just slowed down right here and then started to pull back higher, this is the area we got to pay attention to. Christopher Terry talks about this a lot in his trainings. He calls these areas nodes, right? And I'm going to share with you why this is very powerful and why this makes so much sense when you look at it in this sense, okay? Now, think about how, oh yeah, that probably was news, Erica. So think about how when you think about electricity, right? Electricity has a lot of power. It's what we use for our, you know, to keep our homes, you know, warm and lit and things of that nature. Now, when you have a room in your house, a lot of times there's nodes, electrical nodes built within your house where certain rooms in the house share electricity, right? So if power goes out in one room, it tends to go out in another because they're sharing a node. All a node dictates is that there's a lot of energy stored up in this one area and it's being divided up amongst those two rooms or wherever it may be divided up amongst your house. Same thing with a neighborhood where they have certain areas where there's like huge transformers and they distribute energy out to the neighborhood. They consider that a large node of electricity within that neighborhood. Now, there are nodes within the Forex market as well, and they happen inside of these zones where price moves really fast and then just stops and consolidates. It almost looks like a sound wave when we go to the line chart, like somebody's having a conversation right here, right? Kind of weird looking. That's because this is an area where the banks are having a conversation. If you notice, anything that comes into this area There is a lot of energy stored here because it's a node. So now when price comes into this area, you could expect to see very big movements leave from this area, okay? So at the moment, down here, price moved down very rapidly, hit the brakes, went consolidation mode, jumped out, came back in, bounced out. If we notice, every time price comes into this area, this is where the buyers live, right? Price took off to the upside, all these past areas of resistance, right? Previous highs, all play out. Price came up to that area, dropped right back down, back to the node, jumped right back out. Touches the node, jumps right back out, right? And now guess what happens? Price breaks down into the node, big movement every time it comes near this node, right? Testing, pushed away. Testing, consolidation. This giant candle shot completely through the node and through price all the way to the upside, right? This is how you know when certain areas in the market are very powerful, okay? This is how we wait to see what the market has to offer. And what did price do right now? It is right back at our node zone. And it touched it and moved away from it already. This is where I randomly stopped in that zone, guys, just to draw that out for you. And right now, we're already seeing price at this area testing the area of the node. Now, with GBP having that very bad, well, not very bad, but just having a bad outcome on the news from that what was it? They just went through their inflation rate. So now this puts the Great British Pound in a position to actually run into this node and either A, break right through here, or B, come into here, consolidate slightly, and start to work its way up gradually from this standpoint. But the thing is, you'll know exactly what you're going to get once it gets to that node, because now you can see price has moved away from it for a long time. But as soon as it comes back, you can expect volatile movement. Okay? This is going to give you a much stronger understanding. How do you get out then or ride it? Well, that is a very good question, Tabitha. You are on the ball with the questions, Tabitha. I promise you. So, great question with that one. The thing is, anytime you enter a trade, anytime, your first thought process should be, where is my exit? Okay? Because you're a sniper. You're getting in, you're getting out. Where is my exit? Right? Any kind of, Navy SEAL, Marine, when they go in to do a job, the exit is more important than getting in, right? How am I going to get out of this? Okay? It's easy to get involved in something, but how do you get out? So your first thing is you have to assess what is the risk and how many pips is a good amount of movement for you. Is 15 pips a good amount of movement for you? Is 20 pips a good amount of movement for you? Because most people get into a trade and they want every trade to go 50 pips. Every trade should go 100 pips. Every trade should go 70 pips. That's not realistic, okay? Now, you can have those movements, but your entries have to be on point. Now, if you're starting off and you have a small goal of, hey, I just want to make 20 pips from this trade, you start off with that, right? And now the market starts to move in your favor. Once you go up a certain amount of pips, and this is very key, guys. If you guys don't get anything from me tonight, I want to make sure you understand that if you enter a trade and the trade goes up about 15 pips in profit, if you do not move that stop loss in profit, you are gambling, period. That is all you are doing here. Your job as a trader is not to make money. I'm going to tell you that right now. Your job as a trader is to manage the risk, because every trade you take has risk. There's no way around it, period. But the moment you get the movement from the market, you go up 15 pips in profit, it's looking great. You take your stop loss and you move it just above or below that entry point, so that way you solidify that you will not lose money, okay? You don't give the money back, period. People say, well, Kurt, what if it comes all the way back down and it stops me out and then it bounces right back up again? First of all, first things first, did you lose money? Nope. I made a little bit of money, but it wasn't a whole lot. Okay. Did you have the opportunity to re-enter that trade? Yeah, but I was nervous. Why was you nervous? The first time you took it, it was the exact same setup. It just came back to retest the same area you entered. So yes, it stopped you out, but you have the opportunity to re-enter that trade, and the risk is still there as it was in the first place. You just didn't lose any money as it started to drop down, because just like it bounced back up, it could take you out that trade and keep running the opposite direction and pulled you way deep into the negative. So the entire thing we're doing here is we're not here to make money. We're here to manage our risk. Same thing with swipe trades. When you guys get a swipe trade, the first thing they tell you to do, take partial profits, move stop loss up. It's all about solidifying your gains. You don't give the money back. This is how you become wealthy in trading. You're not here to gamble. You're not here to get a trade. You have a 20 pip stop loss. It goes up 60 pips in profit, and your stop loss is still 20 pips below your entry. That's crazy. What if news happens? What if Trump gets on the mic? You know how he does. And the market just tanks again. That 60 pips that you had, you gave it all away because you never moved your stop loss up in profit to solidify no matter what. You made money. That's it. Everybody you see, Jay Wayne, Dr. Bacon, Greg, Joe, Justin Ford, we move that stop loss, period. It's not about trying to flex muscles like, yeah, I'm out here making money. It's about saying, you know what? I got some gains, move that stop loss up. I'm in for a sale, move that stop loss just below. It's all about, and this is the thing. I would rather you guys have a string of, let's say if you took a trade and every trade you took was $1 per pip, right? Okay. You entered, let me just move this up for argument's sake so you guys can follow along with me. We entered here for a sale, right? The market starts to drop off. We're right about here. Now, I'm going to put this here as our stop loss, right? I'm going to change the color to red. Actually, I can do that from here. Okay. This is our stop loss. This was our interest. This is entry, right? Change this color to green. Makes more sense that way. Okay. Boom. There we go. Now we're cooking. Put this back to purple. Okay. So now price is moving, right? Down, 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 down. The moment we get down into profit, this is the deal. Your stop loss does not belong here any longer. You take your stop loss and you put it here. Okay. You solidify no matter what happens. This green line was where you entered, right? Price is way down here at this point. You move your stop loss here because if the market decides to just run all the way back up and hit your entry point, you didn't lose any money. You got something for your time that you spent in this trade. And as the market starts to move, you gave a little bit of breathing room, right? You don't put it right up on, you know, where price is. You even here, you can put it just a little bit above. So no matter what happens, you keep your money, period. This is what trading is all about. It's not about entering a trade. Your stop loss is here. And you're just like, yeah, we're in, we're all in. Because think about when you go to Cedar Point or Disney World, right? You're on the ride, you're up and down, up and down, up and down. You don't have a goal there. You're just enjoying it. Here, we have to have a goal. So now if you say, okay, well, I want to make 20 pips for this trade, Kurt. All right. The market just takes off, dropping off. You're way past 20 pips at this point. Your stop loss instantly goes to 20 pips, period. Right. If this thing starts running all the way down and all of a sudden it comes back up and stops you out here, you're like, oh, Kurt, it stopped me out. And it kept dropping lower. Did you lose money? Okay. That's it. That's all I care about, guys. I want to make sure no matter what happens, you guys make money. Have a goal. Exactly. Thank you, Jay. Risk management is key. Have a goal. Don't be greedy, right? Bears make money. Bulls make money. Pigs get slaughtered. Period. You're not here for greed. The thing is, there'll always be another trade. There'll always be another trade, okay? The moment there's not another trade, the banks have disappeared and we got bigger fish to fry at that point. So, grand scheme of things, be smart, be mindful, don't be greedy. We're here to make sure you guys understand the basics of what you should be doing. And to the, like Jay said in the beginning, you have to develop good habits in the beginning, right? When you take a trade, I know what happens too. A lot of you guys ain't gonna agree with me, but I know what you do. I've been watching you. I got cameras at your houses. What happens is, this is your entry point, this is your stop loss. You would do this with the stop loss and you never have a take profit. Never. You just riding it, hoping it goes a 200 pip move, and it's just great, right? I love it. Market's moving. I'm in. Okay, it dropped lower. I'm gonna move the stop loss some. Oh, let's go, baby. Y'all just along for the ride, right? It's just getting lower and lower and lower, and no matter what's going on, and then it gets to the point where it drops so far down, you get rid of the stop loss. You're like, I don't even need this no more. I'm good now. This thing's going. I'm in profit. And I'm like, okay, so we were doing great. And now all of a sudden you got cocky because the market started moving really good. But now you're not looking left. Because remember, we just talked about there's a node zone right down here right? That we looked left already, and the market already came down and tested it with this wick, as we already know. So now, with that being said, we could be potentially seeing the market hit this area, bounce, and run right back up, and then you could be losing all that gain you just got from here. Rather than just take the money, close the trade, because the thing is, you can be up 70 pips. The market's moving 100 pips, and you're like, I want 150. How much is a lot for you? Let's just answer that question. How much is a lot for you? Because most people, they have this astronomical thing where they think every single trade is going to go 50 pips and more for them. There's nothing wrong with thinking that, but how many times does that happen? You have to stay realistic, guys. There's nothing wrong with being, lofty, but I want you guys to have your account grow every single day, even if it's just by $2, right? Let's say you take a dollar lot, it's moving down, right? Everything's looking good, and price comes way back up. Let's zoom back in on this for a hot second, right? Price moves way back up and right here, it stops you out, right? You're stopped out. You only made $2 on this trade. So essentially, it's a losing trade, right? But you made $2. I would rather you have a string of $2 losers, right? You won essentially, but it's only been $2. I would rather you have a string of $2 losers in your account than a string of 20 pip losing, 15 pip loser, 30 pip loser. No, it's okay to have bad trades from time to time. You just get in and it just goes negative on you completely. That's fine. But I've seen you guys get in profit so many times and give it all away. Over and over again, give it all away. So the key to this is move that stop loss. Even if you get stopped out and you still see potential in this, it hasn't made a higher high, right? Let's say the market moved back up and stopped us out up here, but we're still evening out, right? We just happen to move our stop loss up a little bit closer to the market, or we got an area caught up in the area structure and it stops us out, retests this and drops back lower. You always have the opportunity to re-enter. Right? Structure is still good. We're still using our trend line. We got a low, we got a high, a low, a high, a lower low, right? Everything we need is here again. We're going to here to here, right? We got a lower low from this standpoint right here. Beginning of this area here, high, low, high. This area broke, put our trend line here. Price is still dropping down. Came up, broke the trend line, hit a level of structure still. Price can come up again, hit this area, and drop back down into that node zone below where this wick is located right here. So everything we have is going to help us along the way. When you right click on the set. Oh no, on this, well, this is trading view. So you say when you right click and set a trailing stop loss. I don't usually use trailing stop losses. I like to kind of manage it as I see fit, because essentially what happens with the trailing stop loss, you run into a problem where if the market's just simply retesting a zone, that trailing stop loss can get caught in that zone, because if it moves up 20 pips, the moment it starts pulling back, that stop loss is going to sit right where it is. And imagine if you have a huge candle, right, and it's just coming back to retest the zone just below that candle, you get stopped out. So I'd rather just use market structure rather than use the trailing stop loss, because I'd rather be more accountable for the structure in the market outside of being, just kind of just lazy with it and letting this trailing stop loss make the decision for me.
Hey, I was able to grow my account just by having a goal. My goal started with $100 a day. That thing could have shot up $500, but I took, because my understanding at first couldn't even understand anything past my goal. Mm-hmm. I couldn't even understand or comprehend the market anything past 50 pips. Anything past 30 pips. So I had a goal in mind, and so I used it as a number. Now I'm able to see it as pips. But okay, when I get between $70 to $100, I'm taking my money. Like I'm closing the trade. And day after day, I did that. And then it walked me up to let me catch 50 pips, let me catch 20 pips. And don't wait for that round number. My goal is 100. Don't wait. Let me get exactly 100, because that boy can stop at 95 and drop on you. Okay, so you got to understand the market. So in the comments, Curtis, it said understand learning risk management first. I would say, yeah. Right after you learn risk management, y'all, please learn market structure. Let's forget about these strategies. Let's forget about these indicators. Forget all of that, because let me tell you why real quick. If you only learn how to use these indicators and these strategies,
you're a slave.
You're going to lose more than you win.
Yeah.
because every strategy, every indicator falls back to what is market structure doing. And so if you learn market structure first, learn lower highs and trend lines and everything like that, then you add indicators and then you add strategies to that. Now you're going to win a whole lot more than you lose. So have a goal and just master risk management and market structure. But that goal is what helped me compound my account week after week, grew it to 15 grand.
Absolutely. Absolutely. Like the risk management side of things is everything. Because if you don't have risk management, you're going to take crazy positions, and then you're going to start to get into these emotional fits. And think about it this way, Tabitha. If you won your last 12 trades, right, all in a row, 12 trades, just straight wins, at that standpoint, you're going to start to have an emotional high. It's not going to be your fault. It's just, it happens naturally. Man, I'm doing really good. It's making sense. I'm making money. Awesome. And then all of a sudden, let's say you have 15 losers right after that. Just like you rode that emotional high, you'll ride that emotional low. We have to get to the point where every trade is just no special. It's no more special than the next one. I don't care if it goes 100 pips, if it goes 3 pips. It's a trade. You made money. You profited. Next trade. Now, when you start making your trading journal, there are certain things inside of that will speed up your learning curve inside of you putting together your risk management, where you'll write down the time of day, you'll write down the currency pair, you'll write down the lot size you took, and a brief description of what you see in the market. Price broke below a level of, once support, now could be resistance, waiting for retest, entering after that, right? And then you'll write that down. If the trade makes money, goes in profit, right? You'll close it out in profit. You'll put a little green highlight over it, right? And you'll do that every time. Something goes right, you'll cover a green highlight over it. If it goes wrong, you won't put a red highlight on it. I've noticed that if you start using red highlighters for your losses, you run into a situation where you don't want to write down your trades no more because you start seeing too much red. So it's like the green is enough. Anything that doesn't have a green on it, okay, it was a loser. We get it. But it'll start to benefit you because now you'll double back and say, okay, all these ones that are green happened during this time of day. All these ones that were green, I entered at a certain lot size, and it just made sense to me because sometimes you'll take a trade and just the lot size alone will scare you into taking bad positions because now you're trading from a standpoint of greed or fear or revenge trading where you lost 3 or 4 trades and now you just got to make the money back. So now you're taking a crazy lot size and you're not thinking clearly. You're just reacting to things now. And your emotions will lead you down a bad pathway when it comes to trading. You have to be able to keep your emotions in control inside of this market. And that's one of the things where people don't get, where as a trader, it goes against a lot of things you've been taught just growing up, where our emotions make decisions for us a lot of times. It can't do that in trading. You have to be even keeled, unbiased, trade what you see, and just let the market come to you. Okay. So it's okay to miss a trade. You don't have to get every single solitary movement and retest, but it's just very important that you find the right times of day that speak to you. You find the right currency pair, because I really strongly suggest you only trade one pair when you first start. And this is really, really true to me, because think about how people trade Bitcoin. I'll just argument say, because I'm like a crypto head, so I gotta show you guys this. So think about how people look at Bitcoin, right? Bitcoin, let me go to the daily really quick. Bitcoin did a crazy run last year in January or November, December time. Bitcoin went crazy. It jumped all the way up. Everybody was loving it. It hit almost $20,000, right? Everybody was like, oh my God, Bitcoin, I want to get in. It's going to be the next, it's going to be the next thing since financial pockets, like the next digital gold. I love it. I love it. And then Bitcoin started to drop off and drop off and drop off. Now, when Bitcoin was growing substantially, right, everybody knew what to do because everybody was watching Bitcoin on the same time frame, on the same thought process. Nothing was scary about it, right? And the price levels meant something to people. When Bitcoin broke 10,000, it was like everybody just woke up and thought Bitcoin was the next, next greatest thing. It changed everything the moment it broke 10,000. Now, I'm saying this because one thing about this is everybody was looking at it in the same standpoint, right? Even right now, Bitcoin's been going sideways, dropping lower and lower and lower. We're finally starting to make a push back to the upside again, and now we're retesting even lower still. I think this is somewhere around the 7,300 level, like testing this area. of resistance right here. It broke out, went sideways, broke out higher, came all the way down to retest this area once again. And we're waiting to see if we break lower and then retest and drop lower still. So it's still in a healthy uptrend. We're just waiting to see. But all these price points make sense here. If I went to something like, let me go back to GBP, JPY. If I went to something like this, right, Great British Pound, JPY, and I said, oh, Great British Pound, JPY is at 145.27 or 279, that means nothing to you, nothing at all, because you don't trade this. If this was the only pair you traded, these price levels would mean so much to you, because now you would say, oh man, if price comes back up to like 149, 148, oh, I'm getting in, because I know last time it got that high, it dropped off substantially. So that 149, 148 area over here makes more sense for you, because now this is the only thing you trade. You become a master of Great British Pound, JPY. When Great British Pound news comes out, you know exactly what to look for, because, okay, if it's bad news and it's in this area, I know what to expect, because last time we had an area where price got in this area, it bounced, broke down into this zone, dropped lower, right? Price got in this area and tore completely through here, retested, dropped lower. Now we're inside of this little ranging zone. And sure enough, price came up, tested this area, looked left, area that was once resistance or once support, became resistance once again, drop off. And this was all because of the news from yesterday, but you would have a much stronger heads up about this, because you looked left, you understood this price zone has a lot of reversals inside of it. So my thing is, one pair can make you very wealthy. I have a friend in Florida. This guy, all he trades is USD JPY. He's 27 years old. He has a Range Rover, a Porsche GT3, and a BMW M3. And he lives in a 4-bedroom loft, and he's no kids, no nothing. All he does is trade Forex.